Good morning, everyone, and welcome to this Sunstone Metals Investor Webinar. I'm Paul Armstrong from Reed Corporate. Thanks very much for joining us. Sunstone has just published a scoping study on its Bramaderos gold-copper project in Ecuador. The study put out some great numbers, NPV of $2.7 billion at spot prices. That compares with the company's current market cap of about $80 million. The payback period put at just 19 months. Of course, Bramaderos is just one of two major projects Sunstone holds in Ecuador. It also has the Palmar copper gold project in the north of the country, but today's focus will be Bramaderos. Managing Director Patrick Duffy will lead this presentation, and he's also going to be joined by CFO Lucas Welsh and Ray Robinson, who's the General Manager of Studies and Technical Services at Sunstone. When the guys have finished going through their presentation, they're more than happy to take questions. If you click on the Q&A tab on your screen and send them through, we'll put them to the guys afterwards. Over to you, Patrick.
Good morning, everybody, and fantastic to have everybody online today. Before we start, just an important emphasis around the disclaimer. This is a scoping study and not a feasibility study, so appropriate levels of assurance should be taken on account of that fact. But equally, the process design and process capex and processing costs were performed by Ausenco, which is a tier 1 engineering house and critical to the overall quality of this scoping study. If I just go to the highlights, so clearly this is a sort of pivotal time in the sort of development of Sunstone, and as we progress from explorer towards advanced exploration and development, amazing result. Credit to the team, highlighting that there's initially a 23-year mine life at Bramaderos in a porphyry ore body that sort of presents very low risk geology, very predictable and very bankable. Across that 23-year mine life, the first eight years is 135,000 ounces per annum and averaging over 120,000 ounces per annum gold equivalent for the life of mine. And all-in sustaining cost of $1,499 per ounce, which puts it in the sort of realms of Ramelius and Capricorn as sort of as top tier gold companies on the ASX. Crucial to that low all-in sustaining cost is the very low stripping ratio, one of the lowest in the industries of 1.4 times. Also the very low cost base in Ecuador with labor, energy, fuel all being much lower than what we would experience here in Australia. The Ausenco design incorporates a 10 million tonne per annum SAG ball mill circuit, including flotation and leach to produce both a gold copper concentrate and a gold doré. And as Paul highlighted, some exceptional economics. We've provided both a base case and a spot case, but that base case using a $3,500 gold price has an after-tax NPV of 0.9 billion or 1.2 billion Australian, and at the spot case of $5,000 gold price, 2.7 billion, which is over 30 times our current market cap. In addition to the scoping study, we still have immense growth potential in the inventory. We believe it will be at least 10 million ounces in resource as we continue to grow the current 3.6 million ounce resource. And once in production, the opportunity is then to expand using cash flow to anywhere from 20 to 30 million tonnes per annum. And then finally, it's in as good a location as you'll find in South America to develop a large-scale project like this. Infrastructure is all there. We're on the Pan American Highway, and we have great support from a very remote community here in southern Ecuador. Just some key metrics here that I've probably covered most of these. Again, confidence in the process design, recoveries, and amazing job done by Ausenco that supports both the capital and the operating costs, and we've already covered the economics. But just next steps and looking forward and unlocking future growth potential. So we're looking to commence some of the work streams around the PFS in 2026 and 2027. There's a few elements we want to complete as part of an optioneering exercise before launching into that PFS. There's huge opportunities around further metallurgical test work to further optimize both the flow sheet and recoveries and the cost base. We are drilling at the moment at Bramaderos, 2 rigs operating, looking to grow the resource in 2026, potentially from 3.6 over 5 million ounces this year. But clearly long term, there's much higher growth. And with that resource growth, there's a potential for a longer term expansion once in production, and using that cash flow to fund the sort of longer term potential. Whilst we're forecasting 135,000 ounces per annum, there's easily scale there for 300,000 to 400,000 ounces per annum, which makes it a very, very attractive project. We've been going through a series of building blocks in the last 6 months. So one of the critical steps was the resource update that we did back in November last year. We upgraded the resource from 2.7 million ounces to 3.6. It's in a pit-constrained resource, which is the basis for the scoping study. But importantly, 600,000 ounces of that resource are now indicated, which is critical to satisfying the ASX requirements. And just to highlight on this figure here on the left, that Bramaderos and Kapiti in the blue, the bottom left is where we're currently drilling and looking to expand the resource this year. Some quotes here from the announcement, but for me, more importantly, if you just look in the background, Melanol, which is one of the 3 deposits, part of the resource and part of the mine plan. You can see the mineralization at surface there on the left of Melanol. It's this contiguous cluster of porphyry deposits that will become one very large super pit over time. Virtually no pre-strip and a stripping ratio of 1.4 times. In the base of this valley, 900 meters above sea level, but really this is a miner's dream. It's one of the most straightforward mining opportunities you'll ever see. And I'll just hand over to Ray Robinson to walk through the technical aspects. Over to you, Ray.
Thanks, Patrick. Bramaderos it's a simple, low-risk mining profile. It's underpinned by well-understood porphyry geology, supporting a straightforward, low-risk mining operation. Mineralisation occurs in a large, continuous ore bodies rather than narrow or complex veins. This enables bulk mining and minimal dilution as well. This style of mining is widely used in South America, and we've used comparable porphyry projects to provide the benchmarked operating costs. And this gives us great confidence in our forecast OPEX for mining. In terms of process, Ausenco estimated both the CapEx and the operating costs for the flow sheet and plant design, and supported the calculation of the metallurgical recoveries. The flow sheet is flotation, but it's also followed by leaching of 100% of the rougher flotation tails. This flow sheet is close to the Boddington flow sheet and to a lesser extent Telfer. As well as the Ausenco bottom-up estimate, we also use Boddington and Telfer as useful benchmarks. Of note in this, though, is there's also clear potential to reduce processing costs as we continue to understand metallurgy and continue to undertake metallurgical testing. Bramaderos is delivering 135,000 gold equivalent ounces over the first 8 years and over 120,000 over the life of mine. As we've said, it's benefiting from that low strip ratio of 1.4, and we're showing the recoveries and annual production profile in the graph. Ausenco prepared the process plant CapEx and processing costs. The site is in a great location. It exists from a paved access road almost to the plant gate. We've got close sources of water. We've got several power options, multiple port options, and 2 ports with existing concentrate shipping facilities. The assumed power option is a combined LNG renewable build, own, operate project, similar to many suppliers in WA. But we'll look at other options in the PFS. The mining operating costs and G&A costs were benchmarked against similar operations and cost jurisdictions. And we obviously experienced that lower relative Ecuador input cost profile for labour and energy. And Lucas will speak a bit more to that later. Our development pathway shows the exploration phase continuing while studies move to PFS. The PFS will have a strong optioneering focus. The optioneering is designed for the requirements of ESHA documentation in our environmental permit. We'll lodge the permit documentation during the DFS stage, and more detailed design will also continue during the DFS. Permitting is expected to take 12 to 18 months, and that'll overlap with the DFS. Early works will include purchase of long lead items, bulk earthworks for the process plant. Construction period of 18 months is envisaged, with production commencing in 2031. Thanks.
Yeah, thanks, Ray. So for the base case, we have used a long-term consensus gold price of US $3,500 an ounce, which is a reasonably conservative outlook given that's around $1,300 below the current spot. But when we look at the all-in sustaining cost of US $1,499 per ounce, this project is still achieving a $2,000 per ounce margin to the base case price, and almost $3,500 to the current spot. So even at this conservative base case price, and without factoring in the likely resource growth we expect to see, results in an NPV of US $0.9 billion. Another important aspect is a reasonably quick payback that we see of 34 months in the base case. But when looking at the current spot, the payback of 19 months is outstanding. Here we show some sensitivities at various US dollar gold prices. And we can see that at most prices, the project is robust. And this is even when considering this is based on our current mineral resource only. So thinking about costs, as been mentioned a couple of times, the OPEX and CAPEX really does benefit from Ecuador's favourable economic environment. Being able to produce its own oil, Ecuador is able to reasonably absorb global oil shocks better. Electricity generated by hydropower. These factors provide benefits in energy pricing compared with many of the jurisdictions listed there. With labour, a major cost input, this is also extremely competitive. And we can see on the graph that this is around about a third of what you'd pay in Australia. So we really do see these benefits in our cost profile. This graph shows the base case cash flows at US $3,500 an ounce. Obviously, we see the CAPEX in the first two periods. We have assumed that production commences in year -1 as part of commissioning, and with commercial production from year 1. We can see here the base case cash flows has the payback during the third year, after which we see very robust cash flows, which obviously could fund further expansions as the mineral resource growth occurs. Now this table shows our all-in sustaining cost of US $1,499 translated into Aussie dollars at a 0.7 FX rate. It compares very favourably with the all-in sustaining costs of recent reported costs from other Australian producers. Clearly, we can see that our cost profile is well below the average AISC. It also places us in pretty good company with some operations such as those in Evolution, Ramilius, and Capricorn.
Thanks, Lucas. And then just stepping back, I guess we've emphasised already just the potential for resource growth. So currently it's 3.6 million ounces pit constrained. And across 5 to 6 porphyry deposits and an epithermal system, there's currently an additional 5 to 13 million ounces growth potential in that resource. And certainly anything over 6 to 8 million ounces would underpin a large-scale second stage processing expansion once in production. Again, just summarising our strategy, we've got 2 high-quality assets, and we'll talk about El Palmar in a minute. We've got a great team, and that's been demonstrated both in the exploration development at Bramaderos and also in this outstanding scoping study. We're in the right commodities, gold, copper, silver, and there's no sign that they won't continue to get stronger and stronger. and then in the background, looking to continue to grow the resources, looking at ways to scale the development, and that's reflected in today's capital scoping study. And then working through a process with RBC in terms of finding long-term partnership solutions. To summarise for Bramaderos, clearly low-risk development with excellent economics, very predictable low-risk geology we've talked about, and the potential to grow significantly. The stage one is being optimised. The project capex, $511 million, is a quarter of what the project NPV is at spot prices. So without doubt, very financeable. Has very low environmental impact. There's no protected forest here. There's no major river diversions. There's no indigenous communities. There's no downstream major population centres affected by the project, and a very straightforward multi-decade mining opportunity. Just to highlight our second project, which at El Palmar, which could be anything. It's a huge potential prize. There's these two porphyry fingers that come from deep and meet up at surface. Based on limited drilling to date, we've got a 1.2 million ounce resource at surface. We believe that could grow to 2.5, 3 million ounces as an open pit resource, and then supported by this deeper exploration target of 15 to 45 million ounces. But really critical to emphasise that opportunity to El Palmar can start as an open pit operation before having to consider the deeper opportunities at El Palmar. Again, the great team and full credit to Ray, Lucas, Bruce for this quality scoping study. We've got a fantastic country manager in Ecuador, Rodrigo Izarrieta, and a very strong board represented by Malcolm Norris as our chairman and Neil O'Connor and Stephen Stroud as our non-executive directors. Looking forward for the rest of 2026, but continue to look at resource growth and drilling with 2 rigs operating at the moment at Capiti, Portillo and Melanol, with ongoing drilling results coming out. Looking to upgrade that Bramaderos resource later this year from 3.6 million ounces, aiming for at least 5 million ounces this year. Scoping studies now delivered, and there's potential with further metallurgical test work and other sort of low-level studies to better update that scoping study in the next sort of 6 to 8 months. We've completed the share consolidation, which has been very important to be able to help position a project of this scale and quality for overseas investment. And as mentioned, we are working with RBC intensely and advanced in the process to be able to attract a partner. And that formal process is delivering great results and has a significant amount of interest, and very confident with the potential outcomes of that process. Finally, market cap sitting around $80 to $85 million. It's a fraction, less 1/30th of the spot valuation of what we've covered today in the scoping study. We're well funded. We've got $8 million in the bank at the beginning of January, and when you look at us on a EV to resource basis, in addition to the scoping study, against our peers, we're approximately $16 per ounce. We should be $60 to $100 per ounce, and there's a huge multiple return opportunity when you review the scoping study and see the quality of the scoping study. So on that note, I'll hand back to Paul and any potential questions. Hi, Paul, just checking you on.
Sorry, can you hear me now, Patrick? We do have a few questions. We'll go through them in the order that they arrived. First of all, one viewer asks, in reference to the $500 million capex figure, do you expect that would be via a partner from the West or from China?
Yeah, no, that's been, so majority of the capex relates to the process equipment and design, and that's been prepared by Ausenco, and that's based on Western EPC contractor pricing. But yeah, we've seen examples where some of the Chinese miners have been able to execute for much lower costs, and certainly that's relevant in the current sort of corporate discussions.
Right. And also we have a question. You seem to be building a twin leach and flotation plant. Are there any opportunities to process neighbouring higher grade ore? Is this a strategic acquisition play around the plant, etc.?
Look, my impression's it's a big bulk processing plant, and that's probably not initially suited. And I referenced that to the King of the Hills gold mine that we built in Western Australia with my previous company, Red 5. And down the hill where Lucas was at St. Barbara, they had the Gwalia mine that was able to toll treat, but that was a 1 million tonne mill versus a 5-6 million tonne mill at King of the Hills. So there is definitely opportunities, but it hasn't been designed initially in the scoping study for that type of flexibility.
Patrick, you mentioned that there are 5 or 6 deposits that comprise Bramaderos. How many pits do you envisage?
Yeah, so initially there's a single pit which covers Brahma, Elba, and Melanol, which is the resource we currently have. Where we're drilling now at Kapiti and Portillo is an extension of that porphyry ore bodies as part of that cluster, and we do envisage that'll be a single large super pit. Further away is Lemon, which is where the epithermal and the deeper porphyry system is. That would be a separate mining centre, and certainly there's other identified porphyry systems that are not in that exploration target that sit in the broader concession.
Another viewer asks, Patrick, can you provide more detail on the partnership and corporate options?
Yeah, so I did allude to the process. We're working with RBC, and they're doing a fantastic job. Certainly more interest than we anticipated, and what RBC anticipated. The focus is certainly on understanding the geology and issuing now the scoping study as a sort of critical milestone in that formal process. And certainly there's a lot of what is attracting parties is the location of Bramaderos being in this southern Ecuador, in the base of this valley that's remote, with a very supportive community, and a sort of dream mining scenario with this large open pit opportunity. So yeah, we're working through the formal process, answering 1,000 questions, and have been on the road with having a number of meetings, and again, very confident that RBC is going to deliver a fantastic outcome.
And in a similar vein, have any of the parties in the data room expressed interest in a straight takeover bid?
Yeah, I don't want to comment on that, but certainly all options are on the table, whether it's a takeover, whether it's a strategic interest at the corporate level, whether it's a asset joint venture, asset acquisition. We are dealing with lots of groups with, I guess, their own preferred transactions, and looking to shortlist them into what's the most sort of compelling offers for our shareholders.
And now you mentioned, Patrick, that there would be a resource update later this year, I think was your phrase. This viewer asks, what would be the sort of order of magnitude we could expect, and where would the resource growth come from?
Yeah, no, so specifically at Melanol, Kapiti, and Portillo is where the 2 rigs are operating at the moment. And we've, I guess, deliberately designed a drilling program that can deliver a significant resource upgrade. We obviously know with the porphyry geology that extends down south of where we currently got the resource, and there's a lot of predictability in the sort of resource definition. So it's those three focus areas that will deliver the resource growth this year.
Would Limon be a standalone development? Is that factored into the scoping study numbers?
No, sorry, no, it's not. I'll let Ray have a comment on Limon.
Yeah, thanks, Patrick. So at this stage, Limon isn't included in the scoping study, where we've looked at ways to integrate Limon into the flow sheet when that comes through. But Limon, we'll still be working up for a mineral resource, but we're not there yet.
So the obvious follow-up question that would be, would Limon be part of a PFS?
Yeah. So I guess Ray's highlighted the steps to that would be to get, there needs to be more drilling to get Limon into a mineral resource, and then metallurgical test work, and that would then enable for it to be included in a PFS. But as we've seen, like obviously this is a large tonnage, relatively lower grade porphyry system and porphyry development, but incredibly profitable, and sort of in that upper echelon of sort of quality gold names in the ASX. But the sort of 1.4 times strip ratio and the local cost advantages in Ecuador mean that we've got a multi-billion-dollar valuation over the three porphyry deposits we have already, and that Limon and the broader Limon epithermal and the broader sort of porphyry exploration targets all represent significant upside from where we are today.
And changing tack a little bit, Patrick, what's the environment like for mining in Ecuador, and is the government supportive?
Yeah, so we've got a president who's very much pro-mining, pro-business, comes from a very wealthy business family in Ecuador. There are a number of, there's two world-class projects, Fruta del Norte and Mirador, owned by Lundin Gold and Tongling, that are in production, and Lundin Gold's a $25 billion single asset company. There's a whole pipeline of large projects now that are benefiting from the sort of push to advance mining in Ecuador. Some have faced opposition where they're sort of in environmentally or community sensitive areas, but it just highlights the huge advantage and why we've got so much interest in Bramaderos, where its location in southern Ecuador, no native forests or major environmental impacts, no river diversions, supportive community, no indigenous community aspects that we need to manage like some other projects do, and confident that Bramaderos could be in production earlier than some of these other larger projects in Ecuador.
Right, Patrick, I think that concludes our questions. So that finishes the webinar, unless there's anything else you'd like to add.
No, that's great. Thanks, Paul, and thanks everyone for attending today.
Right, thank you to everyone for joining us, and a recording of this presentation will be available later this morning.